Just like a sudden thunderstorm that strikes without warning, the market can change direction in an instant. But what if you could predict these shifts before they happen? That's where the power of combining moving averages and RSI comes in. This strategy works for both beginners and experienced traders. Stick around to see why, and if you find it useful, don't forget to like and subscribe for more trading insights. Let's dive in. Required indicators. For this strategy, we need 3 indicators: RSI, a 200-period moving average, and a 50-period moving average. The period settings for the moving averages will vary depending on the type of trading, such as day trading, scalping, swing trading, or long-term investing. At the end of the video, we will explain the appropriate period settings for each of these trading styles. The use of RSI in this strategy. In previous videos, we discussed key RSI features such as the oversold and overbought levels, as well as how to determine trends using the 50 level. If you haven't watched those videos yet, I highly recommend doing so, as they will provide you with a deeper understanding of this strategy. Now, let's briefly summarize the main RSI features used in this strategy. Level 50. If the RSI is above 50, it signals an uptrend, while if it's below 50, it indicates a downtrend. Overbought and oversold levels. An RSI above 70 signals the overbought zone, meaning the asset's price has risen excessively and for an extended period, suggesting a possible reversal or pullback to the downside. An RSI below 30 signals the oversold zone, meaning the asset has fallen excessively and for a prolonged period, indicating a potential reversal or pullback to the upside. Based on the definitions we've covered, we can conclude that when the RSI is between 50 and 70, it signals an uptrend. But the price hasn't yet reached overbought levels, meaning there's still room for further growth. Therefore, when the RSI is between 50 and 70, we look for buy signals and disregard sell signals. On the other hand, when the RSI is between 50 and 30, it signals a downtrend. But the price hasn't yet reached oversold levels, meaning there's still room for further decline. Therefore, in the 30 to 50 range, we look for sell signals and disregard buy signals. So, in summary, in this strategy, if the RSI is between 50 and 70, we look for buy signals. If it's between 30 and 50, we look for sell signals. And if it's above 70 or below 30, we avoid trading. Moving averages and their signals. Now, let's dive into moving averages and their crucial role in this strategy. A moving average is simply the average closing price of an asset over a set number of periods. It helps smooth out price fluctuations, making it easier to identify the actual trend while filtering out market noise. For example, if we use a 20-period moving average, we calculate the average closing price of the last 20 candles. A 30-period moving average would take the average of the last 30 candles, and so on. This helps traders see the bigger picture and avoid getting distracted by short-term price swings. In this strategy, we use 2 key moving averages, each serving a specific purpose. Short-term moving average, 50-period. This moving average reacts quickly to price changes and helps identify short to mid-term trends. It is commonly used to assess recent momentum and spot potential trend shifts. Long-term moving average, 200-period. This moving average provides a broader perspective on the market's overall direction. It smooths out short-term fluctuations and helps traders focus on the bigger trend. The interaction between these 2 moving averages generates 2 important signals. Golden cross, bullish signal. When the short-term moving average, 50-period, crosses above the long-term moving average, 200-period, it signals a potential uptrend and is considered bullish. Dead cross, bearish signal. When the short-term moving average crosses below the long-term moving average, it indicates a potential downtrend and is considered bearish. These crossovers highlight possible trend reversals and serve as key signals for making trading decisions within this strategy. Combining RSI with moving averages for signal generation. For a bullish signal. Step 1. Verify RSI level. Ensure the RSI is above 50 but still below 70. This indicates bullish momentum while helping avoid overbought conditions, meaning there's still room for price growth. Step 2. Confirm with moving averages. Look for a golden cross, where the short-term moving average, such as the 50 period, crosses above the long-term moving average, such as the 200 period. This crossover confirms an uptrend and strengthens the buy signal. For a bearish signal. Step 1. Verify RSI level. Ensure the RSI is below 50 but above 30. This confirms bearish momentum while helping avoid oversold conditions that could lead to a reversal. Step 2. Confirm with moving averages. Look for a dead cross, where the short-term moving average crosses below the long-term moving average, signaling a potential downtrend and strengthening the sell signal. Recommended moving average settings for different trading styles. The moving average periods vary depending on the type of trading. Here are some general settings for different trading styles, but keep in mind that these numbers are broad guidelines and may differ based on the asset and market conditions. For scalping, 3-period and 8-period moving averages. For day trading, 5-period and 20-period moving averages. For swing trading, 50-period and 200-period moving averages. For long-term investing, 100-period and 200-period moving averages. Make sure to adjust these settings based on the specific market and asset you're trading. And that's a wrap. By combining RSI with 2 moving averages, you can improve your trade entries and avoid false signals. If you found this helpful, like, subscribe, and hit the bell for more trading strategies. See you in the next video. Happy trading!